In today's video, we'll be discussing how you can use a Roth IRA to build your long-term investments and help fund your savings for the unexpected before retirement. If you thought Roth IRAs could only be used in retirement, we'll talk about why this is not necessarily true. All right, just a disclaimer here, and a reminder that we're providing general tax information about taxes, and it's really important to talk to a tax professional about your specific situation. All right, so the Roth IRA was introduced as part of the Taxpayer Relief Act of 1997, named after Senator William Roth. It's a type of individual retirement account that allows you to contribute after-tax money for tax-free withdrawals under certain conditions. When we say after tax, we just mean this is the money that's paid to you in your paycheck that's already been taxed by the federal, state, and other withholding taxes that go along with your paycheck. What makes a Roth IRA so attractive to investors is the potential tax savings. If you think you'll be in a higher tax bracket when you retire than you are right now, a Roth IRA may be more beneficial than other retirement accounts, such as a traditional IRA. The reason is that you've already paid taxes on your contributions, so your higher tax bracket won't result in a high tax bill when it's time to enjoy your hard-earned money. All earnings on your investments grow tax-free, as you already paid taxes on the money before putting it into your Roth IRA. Your withdrawals after 59.5 are tax-free as well. This is in stark contrast to a standard brokerage account, in which investment earnings are taxed upon liquidation. Anyone who has earned income can contribute to a Roth IRA, as long as you meet the IRS requirements concerning filing status and modified adjusted gross income. If your income is above the limits, you become ineligible to contribute. For individuals working for an employer, compensation that is eligible to fund a Roth IRA includes wages, salaries, commissions, bonuses, and other amounts paid to the individual for the services that they perform. It's generally any amount that is shown in box 1 of the individual's Form W-2. For a self-employed individual, compensation is the individual's net earnings from their business, less any deduction allowed for contributions made to retirement plans on the individual's behalf, and further reduced by 50% of the individual's self-employment taxes. It sounds confusing, but it really isn't that confusing at all. If you like this video and want to see more of our content, hit subscribe right now. We'd really appreciate it. Now, speaking of limits, for the tax year 2022, if you are filing as single or head of household status, you cannot contribute to a Roth IRA directly if you earn $144K or more. If you're married and filing a joint return, you cannot contribute if you make $214K or more. If you're married but filing a separate tax return, you basically can't contribute, as you cannot make more than $10,000, essentially eliminating this benefit for those married couples filing separately. The IRS doesn't like it. You can make partial contributions to the Roth IRA if your incomes fall below these ranges. If you fall into the phase-out range, you must subtract the income from the maximum level and then divide that by the phase-out range to determine the percentage of the 6K that you are allowed to contribute. Now, there are limits to this benefit as well. You can only contribute up to 6K per year to a Roth IRA, for the tax year 2022 at least. And if you're over 50, you can contribute another 1K for a total of $7,000. Keep in mind that this is the total of your Roth and traditional IRA contributions, and it's reviewed by the IRS each year, so it's always subject to change. All regular Roth IRA contributions must be made in cash. They cannot be in the form of securities, cryptocurrency, or other property. A Roth IRA can be established anytime, and contributions for a tax year must be made by the Roth IRA owner's tax filing deadline. For the tax year 2022, the tax filing deadline is April 15th, 2023, meaning you can contribute to your Roth IRA for the 2022 tax year until this date. You typically only want to wait until after the tax year, though, to contribute if you're unsure of your income for the year and think you may end up going over the income limit to contribute. In that case, you might just wait till the next year. Your contributions were already taxed, so you can withdraw these at any time without any taxes or penalties. And this part's really worth repeating here. You can withdraw your contributions at any time, no matter what, without any taxes or penalties. It's only the earnings that really matter for withdrawals. And with those earnings, if you withdraw earnings and your account is over 5 years old, those are also tax-free. However, if your account is less than 5 years old and you withdraw earnings, you might be subject to taxes and penalties if you do not meet the requirements for a qualified distribution. The earnings would be taxed according to your ordinary income rate and incur additional penalty of 10%. Here's an example. If you have contributed $20,000 to your Roth IRA over the last few years, and it is now worth $25K, your account has $20,000 of contributions and $5,000 of earnings. You can withdraw up to $20,000 at any time because you have already paid taxes on these contributions. However, if your withdrawal exceeds that amount and dips into the $5K of earnings, you might be subject to those taxes and penalties, especially if it's under 5 years old. So let's talk about qualified withdrawals. Distributions eligible under IRS regulations are referred to as qualified distributions, while withdrawals that do not meet requirements are referred to as non-qualified distributions. Any non-qualified distribution is subject to capital gains taxes and a 10% penalty. Understanding the difference and avoiding unnecessary tax expenses is critical to understanding the Roth IRA benefits. If you're over 59 and a half, you don't need to worry about any of this. Almost all withdrawals are tax and penalty free. Now, if you're under 59 and a half, you may avoid both the taxes and the 10% penalty if your withdrawal meets one of these situations. You have a qualifying disability, your estate or your beneficiary is making the withdrawal after your death, you are purchasing your first home. In that case, you can use up to $10K for this. But that's not all. If your withdrawal is not qualified, but one of the following situations applies, you would only owe the taxes on the earnings, but avoid that 10% penalty. If you're using the funds to pay for college expenses for you or your family members, if you're paying for medical expenses that exceed 7.5% of your adjusted gross income, or you lost your job and you used the funds to pay for your medical insurance premiums. In those cases, you avoid the 10% penalty, you just pay the taxes on the earnings. If you're over the income limit to contribute to a Roth IRA, you technically cannot contribute directly to a Roth IRA. But if you like the idea of tax-free growth, I do, the Backdoor Roth could be a great option. In a Backdoor Roth IRA, you make a non-deductible contribution to a traditional IRA for the purpose of converting it to a Roth IRA. Qualified Roth IRA distributions, unlike traditional IRA distributions, are not taxable. This can mean significant tax savings in retirement. The main advantage of a Backdoor Roth IRA, as with Roth IRAs in general, is that you pay taxes up front on any pre-tax funds converted, and everything after that, principal and earnings, is tax-free. If you think that tax rates are going to rise in the future, or that your taxable income will be higher in the years after your Backdoor Roth IRA, then this can work to your advantage. Traditional IRAs don't have income ceilings for participation, and since 2010, the IRS has not had income limits that restrict who can convert a traditional IRA to a Roth IRA. As a result, the Backdoor Roth IRA has become a tax planning opportunity for higher income taxpayers who ordinarily would not contribute to a Roth IRA directly. Wealthfront automates this process, so it takes just a few clicks. Once you've completed the conversion, you get the same tax benefits you'd get if you contributed to a Roth IRA directly. We'll provide a link below to check it out. Roth IRA account holders are not subject to the required minimum distributions required from a traditional IRA or 401k, which require distributions starting at age 72. This means account holders do not have to pay to withdraw distributions at any point while they're alive, which could be a good estate planning technique to pass on wealth to future generations. If you pass a Roth IRA to an heir as an inherited Roth IRA, they benefit from tax-free withdrawals as long as the account was held for at least 5 years at the time of the account holder's death. You can contribute to a Roth IRA in addition to a 401k, and you can withdraw the money you contributed at any time without taxes or penalty. You can also open a Roth IRA at any age as long as you have earned income, and that's the key. You cannot contribute more than your earned income. This can be a valuable savings tool for kids who have income from side jobs. Now, you have to wait 5 years from the tax year of your first Roth IRA contribution to withdraw earnings tax-free. That's one drawback of the Roth IRA. Another one is that Roth IRAs do not give any tax deductions during the year that you contribute, unlike with the traditional IRA. Tax deductions can be helpful as they reduce your adjusted gross income, which also can reduce your overall tax bill for the year. If you're in a high income tax bracket but still eligible to contribute to a Roth IRA, you might consider the traditional IRA to take advantage of the tax deduction benefit. If you want to learn more about traditional IRAs and other types of IRAs, we'll link those videos below. I'm Tony from Wealthfront. Thanks very much for staying tuned. Take care.